FedEx moves millions of packages a day across a massive global infrastructure. In the third quarter of 2026, the company maintained a standard baseline of financial health, with top-line revenue growing to $24 billion. However, highly specific structural costs are currently rising alongside that revenue growth, aggressively eating into operating margins. The Q3 2026 income statement reveals the scale of this discrepancy. Against that $24 billion in revenue, the company recorded $202 million in separation and other costs and $65 million in business optimization costs. This $202 million separation cost represents a massive increase compared to the $5 million recorded the previous year. The $65 million in optimization costs brings the year-to-date total to $162 million. These specific line items represent the empirical footprint of a deliberate corporate teardown. FedEx is currently dismantling its legacy operational silos to restructure its $94 billion asset-heavy network, prioritizing long-term agility over short-term margin protection. To locate the capital reserves fueling this teardown, we have to look past the income statement and examine the balance sheet. The Q3 balance sheet shows $3.68 billion classified strictly as restricted cash. This capital represents the net proceeds from a private debt offering executed by a newly formed subsidiary, FedEx Freight Holding. FedEx is using these funds to execute a full, tax-free spin-off of its highly profitable less-than-truckload division by June 2026. Less-than-truckload, or LTL, refers to freight shipments that are too large for parcel carriers but do not require a full 60-foot trailer. The $195 million in separation costs found on the income statement paid for the professional fees and incentives required to legally uncouple this massive logistics network. These twin trailer trucks represent the physical reality of the LTL assets being spun off into the public market. Walling off the freight division allows FedEx to isolate its most capital-intensive trucking operations, leaving the remaining core corporate structure lighter and more agile. The core business is now integrating its historically separate express and ground delivery networks. The legacy architecture was defined by inefficiency, with separate express and ground vehicles operating in parallel silos, often driving identical routes. This redundancy is being eliminated through Network 2.0, a multi-year optimization program that accounts for the $162 million in year-to-date optimization spending. The operational mandate for Network 2.0 is to replace discrete, siloed collaboration with a unified end-to-end optimized system. FedEx has already implemented this optimization across 390 locations in the US and Canada, consolidating sortation facilities and streamlining line haul routes. These merging operations involved a complete reconfiguration of the physical sortation facilities and the conveyor systems that move millions of packages a day. The financial yield of these restructuring efforts can be seen in the recently completed Europe Workforce Reduction Plan. While the Europe plan required $250 million in upfront costs, it locks in $150 million in annualized structural savings starting in 2026. Network 2.0 deliberately absorbs short-term margin pain to purchase long-term structural efficiency, eliminating the redundancy that has historically limited the company's profitability. While restructuring its core, FedEx is also deploying its $8 billion in unrestricted cash and cash equivalents. The company has already deployed $776 million into stock repurchases this year to provide yield to shareholders. FedEx is also making a $2.6 billion strategic move to acquire a 37% stake in InPost SA. This acquisition provides FedEx with access to a massive automated locker system to handle last-mile delivery in international markets. The company's 10Q filing notes that this European e-commerce acquisition will be funded through existing unrestricted cash balances rather than new debt. This Sankey diagram tracks how $5.66 billion in year-to-date operating cash flow is being distributed across capital expenditures, share repurchases, and the InPost acquisition reserve. FedEx is weaponizing its cash flow to secure high-density automated e-commerce infrastructure in critical international markets, moving beyond simple spin-offs and consolidation. The financial anomalies in the Q3 2026 income statement serve as the final necessary friction points of a multi-year corporate metamorphosis. Post-2026, 3 legacy pillars are replaced by a unified Federal Express core, an independent freight company, and an in-post international pillar. $5.66 billion in cash flow absorbed Network 2.0 costs, while $3.7 billion in holding notes financed the freight uncoupling. The upcoming shift of the fiscal year to December 31st marks the final break from the legacy corporate structure. This entire transition is designed to change how the public market values the company's newly structured assets. By mid-2026, institutional investors will value a structurally leaner, highly integrated entity that has systematically eliminated its legacy fragmentation.